Good afternoon, everyone. Thanks very much to Better Finance for the invitation. It's a pleasure to be here in this wonderful setting. It's also a good opportunity to escape the scorching heat wave in Paris. So I'm also glad to be here for that reason, but not only for that reason, of course. That's indeed a very important agenda that we're discussing today. I think the presentation that took place before were a very strong, very robust introduction to this topic. And I would try to take perhaps a slightly different perspective and broaden the lens a little bit beyond taxation, properly speaking. Can I just give it a try, clicker? Okay. Maybe something. Just a second. Otherwise, I think okay. One more time. Okay. Yeah, something got pressed, but it worked. Okay. So yes, like I said, I will broaden the perspective a little bit beyond taxation issues specifically. And I would like to basically raise this issue, which is on the mind, which keep policymakers awake at night these days in Europe, which is why does Europe, despite its strong institutions, abundance savings, why does Europe struggle to fully mobilize its capital for growth? And I will focus on what we see as the key missing link, which is retail participation in capital markets. And from there, I will turn to two critical levers shaping this participation. It's financial literacy and the design of incentives, in particular through a retirement savings system. And finally, I will touch on how fragmentation, including on tax policy, continues to limit the integration and effectiveness of our capital markets in Europe. So, of course, starting with Europe, structural challenge. As I said, Europe is a continent of strong institutions, immense savings. If you think of the growth, the savings rate, it's around 15.3% in Europe of gross disposable income compared to 10.8% in the US. So there is a vast bucket of savings in Europe that should be exploited, and which is in fact underutilized. And one reason indeed is that capital markets in Europe are fragmented, and this is very much one priority in the context of the savings and investment union. This fragmentation has tangible consequences for our economic dynamism. I would like to mention a few numbers. Over the past 50 years, only 14 companies with a market cap above 10 billion have been funded in Europe, in the EU. This is compared to 240 in the US. So that's pretty telling. In the US, young firms, those that are under 50 years old, they represent a market cap of around 43 trillion US dollar. In Europe, this is around 5 trillion US dollar. In Europe, the median funding year of the 10 largest listed firms is 1911. In the US, this is 1985. I mean, I'm sure you know all those numbers very well, but still, I think it was good to put those numbers up front to capture your mind. But again, I'm sure you know all of that by heart. What does it suggest? European economy, which is an economy where incumbents dominate, where the emergence of new disruptive firms is comparatively rare, especially vis-à-vis the US, and where the ability to finance and scale innovation is somewhat problematic. And of course, this carries implication for productivity and growth. And Mr. Chair, you mentioned the Draghi report. That's at the core of this report. Next slide, please. So now I'd like to focus on retail participation because that's certainly one missing link among several. And indeed, one might expect that Europe's vast pool of household savings would help bridge this gap. But this is precisely one of the challenges that Europe is facing. Retail participation in European capital market remains surprisingly low. Of course, no need to mention to you how important retail investors are. They are an essential component of a well-functioning capital market. By channeling household savings into productive investments, they help diversify funding sources for business, support innovation, and strengthen the resilience of the financial system. Retail participation is also a means to offer opportunities for households to diversify their assets and participate in the growth and success of the corporate sector. And the scale of this potential is considerable. European households, they hold close to 39 trillion euros in financial assets. And yet, a very large share of these financial assets remain concentrated in low-yield instruments, such as bank deposits, which alone account for 30% of the total. Just to give you an order of comparison, in the US, it's only 12%. And of course, US households, they are allocating significantly more of their wealth to market-based instruments. And actually, and it's something that we see on this slide, retail participation has nonetheless increased over the years, but it remains a challenge globally. So indeed, household investment in capital markets, in particular through pension funds and investment funds, has increased. But what we see also, this investment remains uneven across countries and across households. Next slide. And we see on this chart that indeed the investment ratio by country is pretty diverse according to jurisdictions. It's also diverse in terms of the level of income of households. And indeed, it's relatively low, specifically low, in fact, when you consider lower wealth households, which are significantly less likely to participate in capital markets. Next slide, please. And it was mentioned before, this is particularly important when we consider the macro financial environment of the past decade. We had prolonged periods of low interest rates, which significantly reduced returns on deposits, while inflation, although fairly low over the past decade, eroded their real value. More recently, we've seen, of course, an increase in interest rates. So on the face of it, it's a better situation for saving instruments, but we've seen also a very strong uptick in inflation. So this issue of the case for diversified long-term investment remains strong. So now what explains this gap? Why do European households, despite substantial wealth, participate less actively in capital markets? So there are structural issues which, of course, are front and center in the agenda of the savings and investment unions of the EU. But there are some issues which are more specific and which I will mention there beyond those issues of fragmentation, which are usually mentioned in the context of the SIU discussion. And I would like to, in particular, to focus on, and to start with, on financial literacy. Next slide, please. Because really, financial literacy is what I would say brings citizens to capital markets. I mean, this is one of the conditions. And really, financial literacy matters for households to participate actively in capital markets. And the expansion of retail participation depends precisely on the ability of individuals to make informed decisions. And here, the evidence points to significant gaps. And at the OECD, we undertake regularly surveys of adult financial literacy. The latest one dates back to 2023. And we show, so I don't know if you manage, so it's the slide before, please. I don't know if you managed to read it, but in fact, it is the bar at the bottom. Only 39% of adults in OECD countries met in 2023 the minimum target score on financial literacy. And this has obviously direct consequences on financial decision making. Next slide, please. Now, if we focus on younger generation, we may think that maybe they are more literate in terms of the functioning of financial markets. Not really, in fact. If we focus on younger population and we have this PISA survey, I'm sure you know the PISA survey for education systems in general. Your countries have more or less well-performing education systems. So that's the general PISA. But in fact, within PISA, we have a specific component focusing on financial literacy. And there, if we look at, in particular, 15 years old, fewer than 1 in 15 years old understand basic concepts such as diversification, dividends, or return on investment. So very, very basic. So it's not even about basic math. It's really about basic notions, which even young generation don't really grasp. And digitalization adds another layer of the challenge. Around 40% of adults lack basic digital financial literacy, making it harder to navigate online financial services safely. Doesn't prevent some of them to invest in very complex products like crypto, but with a lack of basic financial literacy, which is a bit worrying. And precisely this is worrying because at the same time, the risk environment is evolving rapidly. According to, we published this year, the OECD Consumer Finance Risk Monitor, which shows that about 15% of individuals report having experienced financial fraud or scams, and 80% of jurisdictions within the OECD identified fraud as a top consumer risk. And these challenges, again, are not evenly distributed. Lower levels of wealth may constrain households' ability to participate in capital markets, with households in the bottom 50% of the wealth bracket allocated considerably fewer assets to financial investment than high wealth households. Of course, there is an issue of wealth specifically, but there is also an issue of financial literacy. So all these figures, they help explain part of why many households remain in low-yield assets, why participation in capital markets is limited, and why new digital tools will not automatically lead to better outcomes. Next slide, please. So now let me say a word about precisely the agenda of the day, which is taxation and incentives, and to what extent they are shaping behavior. As was said before, if the tax treatment of financial products is complex or opaque, it adds an additional layer of difficulty. Individual needs to understand not only the risk and returns of an investment, but also how those returns will be taxed. And in that sense, I would say there is an element of tax literacy, which is in a way perhaps as equally important as financial literacy, properly speaking. And in fact, tax rules can either support or hinder individuals' ability to engage with financial markets. Maybe this is not the main driver, but it comes on top of the rest of the structural drivers of participation in financial markets. So in a way, my message here is straightforward, is that indeed taxation contributes to shape behavior. It influences participation, investment decisions, and ultimately the allocation of capital. And still, international experience shows that investors are pretty sensitive to the design of tax systems. Complexities, uncertainty, administrative burden, they can discourage participation just as much as high tax rates themselves. I will not, I was planning to talk about the Swedish ISK. I won't do that because that was very well done by Alexandra and in much more detail, in a much more granular manner than I was planning to do. But just to say that when we look at OECD countries in general, what we see, and that's one of the main traits, many countries have introduced or are introducing dedicated savings and investment accounts with simplified and preferential tax treatment. So the trend is positive from that perspective. And that reflects also the widespread use of tax policy to support precisely retail participation. I'd like now to focus on retirement savings for a few minutes and long-term incentives in practice to precisely enroll in asset-backed pension systems. The role of taxation becomes particularly visible when we turn to retirement savings systems, which are one of the main channels, in fact, through which households participate in capital markets. Across OECD countries, virtually all governments provide financial incentives to encourage individuals to save for retirement, reflecting, in fact, what was mentioned by Mr. Chair, a shared concern that households may otherwise undersave for the long term, especially if they rely only on public pension systems. These incentives, they are far from marginal. In most countries, the tax treatment of retirement savings differs significantly from that of other forms of saving. So here, we are indeed departing from neutrality, but perhaps for good reasons, I would say. And this often results in a lower overall tax burden over the life cycle. Next slide. No, it's actually, no, you can go back, sorry. So in practice, many systems rely on some version of a deferred taxation model. Under this approach, contribution and investment return are either exempt or lightly taxed. And in fact, the taxation takes place mostly at when the benefits are perceived by the pensioners. So that's very much the EET model. And you can see that most OECD members are actually under the EET model. And the design is, yes. So EEE is that there is exempt contribution, investment income, and benefits. So it's a full exemption. And there are indeed some models where the contributions are taxed, but the benefits and the investment income are exempted. Of course, it has we'll get back to this maybe during the panel, but it has a different impact in terms of the fiscal cost of these kind of systems in terms of tax revenue. So precisely the EET system is intended to support long-term accumulation over the life cycle. The scale of these systems is significant. In most OECD countries, asset-backed pension plans now represent a major share of total household financial wealth, playing a central role in linking households precisely to financial markets. At the same time, the way incentives are structured varies widely across countries. Tax relief can take different forms: exemptions or deduction for contributions, reduced taxation of investment income, or favorable treatment of benefits. And this favorable treatment can vary across the types of retirement income payments, whether it's annuities, drawdowns, or lump sums. And in addition to tax incentive, many countries complement these frameworks with direct support, non-tax incentives. Around 17 OECD countries provide non-tax incentives such as matching contributions or even fixed subsidies that are paid directly into pension accounts. These design choices matter for behavior, of course. Appropriately designed incentives can increase both participation and contribution levels, especially in voluntary system. However, here again, there are policy trade-offs, and we must be aware of those trade-offs. Tax incentives tend to be more beneficial for higher income households, obviously, those that are taxable, especially in the context of progressive taxation systems. And we see, and it's no surprise, that lower income individuals are often more responsive to simpler and more visible mechanisms such as matching contributions, so non-tax incentives. Complexity is another key issue. In many countries, retirement savings rules differ depending on the type of plan, the source of contribution, the stage of the investment, and also they tend to change over time, so there is a lack of stability in the tax rules. And this complexity can reduce the uptake and undermine the effectiveness of incentives over time. And so this brings us back to a broader point. Retirement system illustrate particularly well how tax design, financial incentives, and behavioral response interact. Next slide, please. Just would like to say a quick word about EU tax harmonization. In French, we have a word for that. It's serpent de mer, so something we are always talking about and that never happened. It's actually partly incorrect. In fact, there's been some level of tax harmonization when it comes to indirect tax. You can think of VAT. But when it comes to direct taxes, including personal income tax, corporate tax, and withholding taxes, those remain largely national. And this fragmentation has practical consequences. It increases compliance costs, creates legal uncertainty, and reduces incentive, in particular for cross-border investment. And I'd like to take the concrete illustration of withholding tax procedures. Investor operating across border in Europe, in the EU, may face more than 450 different forms of withholding procedures, which are also, by the way, only available in national languages. So good luck, good luck. And of course, you think of experienced investors that are facing this type of hurdle, but when we talk about retail investors, of course, they don't have the capacity to deal with this. And as a result, some investors, they forego refunds, and others just avoid the cross-border investment altogether. And this affects both sides of the market, households, but also the firms that face a smaller and more fragmented investor base. And this is what is at the core of the FASTER directive that has promised to basically address this issue. I don't know. We'll see. So these are technical reforms, but it has a very direct bearing on also on retail participation capital market, especially if we take a EU-wide perspective. Next slide, please, to conclude. So taking a step back, a consistent sort of a policy perspective emerging. It's nothing revolutionary, really, but it's first improving financial literacy. So 3 words: education, 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 and it's also true for financial education. We often focus on education at large, but actually financial education is really part of the curriculum, or should be part of the curriculum. And at the OECD, we're also insisting very much on these aspects. Well-designed retirement systems to channel savings into long-term investment. That's also a main channel. And reducing tax fragmentation, in particular, to improve the functioning of markets across borders. So Europe has the savings, it has the institutional capacity, the policy tools. So let's make it happen. Thank you very much.